Holding the right amount of cash is important, but how much cash should you hold as an investor? Where should you hold that cash, and what alternatives to cash are there? We regularly get asked these questions, and in today's video we're going to answer all of them. Let's check it out.
Welcome to MoneyUnshackled.com, the investing and finance channel that sets you and your finances free.
I'm Andy and that was Ben, and if you like what we say, hit the like button and click subscribe. Reasons to hold cash. Other than your day-to-day living expenses, there are a few reasons to hold cash. An emergency fund, an expected large purchase soon, such as a holiday or a car, and as a part of an asset allocation strategy.
Awful returns. Normally, we don't want to be holding too much cash because of the awful returns that it generates. These returns have been atrocious for 10 years or so, and are getting worse and worse all the time. Right now, you will be lucky to be paid 0.5%.
You can squeeze a little more out of your savings if you can be bothered to constantly move your money from one bank to another. But it seems pointless to us chasing pennies, particularly if you don't have much cash to begin with.
Even if you have £10,000 in cash, is it worth the hassle to research the best accounts and move your money if the interest rate only improves by 0.2%? That would only increase your returns by 20 quid in an entire year. Hardly worth the hassle.
One of the main reasons to hold cash is liquidity. You want the ability to access your money at the drop of a hat. So be very careful about saving in a notice or fixed rate account in order to squeeze a little bit of extra interest out of your money. Not being able to access it defies the point in holding cash. There aren't that many circumstances when locking away your actual cash is a good idea.
The silent assassin. The awful interest rates though are not the main reason why you don't want to hold a lot of cash. The amount of cash you hold will vary over time, but generally you should have it as low as possible due to inflation. Inflation is on average around 3%, so if you hold cash at 0.5%, you're getting an effective negative real return of 2.5%.
Emergency fund. With the interest rate on cash being so horrendous, some people may even go as far as holding near zero amounts of cash. But it's very important to hold a minimum level of cash, in our opinion, as an emergency fund, in case things go down the shit.
We've covered emergency funds before in other videos, but as a recap, most financial advisors and journalists suggest that you have between 3 and 6 months of living expenses in cash. Personally, neither of us would be comfortable with just 3 months of living expenses in the bank. But it depends entirely on your personal circumstances. The idea is if you lost your job, for example, you could survive long enough to replace your income. We believe that those who hold a sizable pot of 12 months or more of living expenses hold significant power and flexibility above and beyond the cost of holding that cash.
In our previous careers, we were able to negotiate huge pay rises from our employers because we were in a position to demand pay rises rather than timidly ask or even bluff. What most people say is, "Please sir, can I have a pay rise?"
No, you can't.
Okay, I'll try again next year. Our emergency funds meant we could leave in an instant if required, which is why we jokingly call them F-off funds. So in this context, a cash emergency fund is invaluable.
It's important to understand that this emergency fund is exactly what the name says it is. It must never be touched except for in an actual emergency. A 20% sale at ASOS is not an emergency, nor is a meal with friends. Yes, I know we're party poopers.
We would even go as far as to say that a car breakdown is not an emergency because car maintenance is a semi-regular expense and so should be budgeted for. You know that your car tyres need replacing every so often, and so it's a good idea to have a separate pot for irregular expenses. As an investment channel, many of our audience might even consider using their emergency fund to invest if the market's crashed. Don't do this. Holding cash back to invest should only come from a dedicated cash allocation within your portfolio.
The size of your emergency fund could also factor in things like the sources of your income, or a supporting family that you could fall back on should disaster strike. If you have multiple income streams, such as 2 jobs or a side hustle, then there is less risk of losing your entire income in one fell swoop, so you could have a smaller emergency fund.
Cash as an asset class. Next, we need to decide how much cash to hold within our investment portfolios. The main asset classes are equity, bonds, property, commodities, and cash. How much money you allocate to each asset class will depend on your own circumstances. And we've covered this many times on this channel, so feel free to check out the back catalogue of videos after this one.
We personally favour equity and property, but currently also like to hold lots of cash due to how expensive all the other asset classes seem to be at the minute. This is painful because we also believe that cash is worthless in the relative sense. The amount of cash that you should hold for investing is well debated. One school of thought is that trying to time the market is a fool's game and results in worse performance overall.
These people believe that it's not worth taking profits on equities in anticipation of falls because it's too difficult to successfully achieve. When we're filming this at the end of August 2020, many investors are anticipating a stock market crash, so they might shift from stocks to cash, but who really knows whether a crash will come? They could end up sitting on cash for years, which would be a major drag on overall profits.
Excluding emergency funds, we've seen advisors recommend cash allocations in your portfolio from as low as nothing to as high as 30%. The higher you go will really depend on your ability to time the market. If you are an inexperienced investor, we would say maybe hold between 3 and 5% in cash and try and remain mostly invested in the market. There's a lot of research which shows that long-term investors who stay invested perform better than those trying to predict and take advantage of volatility.
I almost never shift from equities to cash, and when I have, I've tended to regret it. Having said this, I'm actually sitting on about 30% cash right now, but this is more because I was planning a new business venture but have since changed direction. This wasn't because I bailed out of equities. This money now needs to be poured into shares, but I'm choosing to drip feed it in over several months, unless of course a crash presents an opportunity. I'm personally targeting a long-term position of about 10% in cash.
Cash as a defensive asset. 10% might seem quite high in a worthless asset class, but in this case, it's being used as a substitute for other defensive assets, such as bonds. Many investors build a portfolio of equity, stocks and the like, and then seek to temper the volatility by investing in bonds and gold. The idea is that the diversification will protect the portfolio when one asset class goes down.
Our regular watchers will know that we're not keen on bonds and haven't been for over 10 years. In any case, bonds and gold are both looking very expensive right now, with gold hitting record highs and bonds offering extremely low yields, sometimes negative. It takes a brave investor to pile in when things look this expensive.
I like to hold a small 5% allocation in gold, but both gold and bonds are a risk compared to cash because they can fall in value in nominal terms. So I'm reluctant to hold too much gold as a way to defend my portfolio's downside. Of course, cash is guaranteed to fall in value in real terms, but is less volatile than gold.
Where to hold cash? Emergency fund cash should be held in an instant access savings account. We tend to avoid any account that even have a 1-day delay in withdrawals. You want that emergency money fast. With today's awful interest rates, I tend to use the savings account from the same provider as my current account, as at least access is good and it's convenient to have your money in one place when doing mobile banking. Any cash set aside for a large purchase could go in a separate savings account.
Next, we need to decide on where we keep our investment cash allocation. We, and probably most of you, invest via a stocks and shares ISA, and we know that the platforms either pay nothing on cash or at best, next to nothing.
The problem is we cannot withdraw from these ISAs and deposit the money elsewhere because we only get a deposit allowance of £20,000 each year. So unfortunately, I have a big pile of cash just sitting within my main account and it's constantly being chopped away by inflation without any interest at all.
There is an alternative to cash which could be used instead, but this does introduce some risk and a slight delay in access. If you've been astute, you may have chosen one of a few stocks and shares ISAs that are flexible. These allow you to withdraw and then later replenish without consuming your ISA allowance. The Vanguard platform offers one of these rare gems.
Alternatives to cash. One way to defend against inflation and maintain low risk is to buy index-linked government bonds. We personally don't use these, but one such fund is the Vanguard UK Inflation-Linked Gilt Index Fund. These are useful because they are very liquid and seek to protect you from inflation.
If we wanted an investment which is almost as liquid as cash but still gets some return, then we could look at money market funds, such as the Vanguard Sterling Short-Term Money Market Fund. This fund and others like it are attractive because the net asset value of one share should never fluctuate. Moreover, unlike cash in our ISAs, we can still earn a yield of 0.41% with this fund.
Question of the day. Ignoring your emergency fund, what allocation of your portfolio is in cash and why? Let us know in the comment section. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.